All right, welcome everybody to our Oncore webinar, The Economic Road to Recovery, or as Brian's put there, a post-COVID world. What does it look like? I was reading something last night that $230 billion of stimulus had been invested or committed by the government. And to put that in perspective, I think during the GFC, Brian, $52 billion was committed. So with a lot of that stimulus coming off at the end of this quarter and then the end of March, I think everybody's question in their minds is, what does it look like going ahead? So it gives me great pleasure to introduce Brian, who's going to help us with that question. Over to you. The format today is basically Brian's going to run a presentation, and then we've left plenty of time at the end for questions. So feel free to put your questions in, and we'll hope to address them towards the end. So over to you, Brian.
Great pleasure, Damian. Thanks very much to yourself and to the Oncore team for the invitation to come and speak, and thank you everybody for your time today. It's every now and again, it's funny how many people do like to bag out economists, but in times like this, I don't think I have ever been busier. Never before have so many people wanted to hear from an occupation that apparently has so little credibility. So let me talk you through about how we're sort of seeing the world right now. For those of you who don't know Sunsuper, we manage about $70 billion on behalf of 1.4 million members across Australia, although as you could probably tell by our marketing, at least about 50 to 60% of those are in Queensland. Now, also a quick word from our sponsors. The compliance people would like you to pay no attention to everything you're about to hear. This is really the main messages from today. There is no point in someone like me trying to turn up here and sugarcoat what is going on in Australia and indeed the world right now. This is the worst global recession, the worst Australian recession in living memory. We have not seen anything like this confront the world since the 1930s. In a health sense, in order to try and find some kind of historical precedent for what a health crisis like this might do to the world economy, you really need to go back over 100 years to Spanish flu and the impact that had. Make no mistake though, there is a recovery underway. But that recovery was and was always going to be very uneven, very gradual, very, very patchy, that you're going to see, and you are seeing, a lot of variation, not just between different countries, but between different regions of the one country, between different industries. And there is inevitably going to be setbacks along the way. And we've certainly seen those setbacks play out, obviously here in Victoria, but also in parts of Europe, parts of the United States as well. There is a recovery underway, and that recovery has been helped by truly unprecedented levels of government stimulus. And Damian, as you mentioned, if you look at the dollars involved here, the dollars relative to the size of the economy is really the most appropriate yardstick. What governments have done in the last 6 months really does dwarf what were then really quite extraordinary efforts during the global financial crisis. And in reality, this really does reflect the magnitude of the downturn that we're in. Paul Keating once famously got into trouble for describing the early 1990s recession as the recession we had to have. I would argue that this very much is the recession we had to have. This was a recession that didn't come about because of any major imbalances or structural problems or overheating in the economy. This was a recession that was engineered by policymakers in order to deal with the health crisis and in order to keep fatality rates and infection rates as low as possible. That makes it really, really different. It means that ideally, it means that once you bring the virus under control, that you should be able to return to something vaguely resembling a normal economy. But it's really difficult to imagine right now what normal looks like, not just in a range of countries, but certainly in a range of industries. Despite the massive efforts we've seen from governments and central banks around the world, I think governments have more to do. There is not much more that central banks can do once you've reduced interest rates to virtually zero or negative in some cases. Once you've thrown a lot of money into the financial system, you really can't do a hell of a lot more than that. The way monetary policy, the way central bank policy is meant to work is that you make it attractive for people to borrow money. and to take that money and go out and spend it. In this kind of environment, you're just not going to get the same sort of bang for your buck, because people are going to be much more cautious about adding to their debt levels in an environment like this. In that sort of environment, this is where fiscal policy, this is where governments really need to step up. There is no point in worrying about the size of the budget deficit or the size of public debt. That will take care of itself over time. But certainly I think governments do have more to do, both in terms of supporting households and supporting businesses, but helping to underwrite the recovery through spending on things such as infrastructure, both here in Australia and indeed globally. Just to finish this main messages slide on what does the recovery look like, and I suppose a follow-up question is, how much has COVID really changed the world? And this is really very much an open question that no one has a good answer to. Working arrangements. And this means, what does it mean for the industrial relations landscape here in Australia and globally? What does it mean for those industries that have relied somewhat heavily on a casual workforce as opposed to a permanent workforce? We've seen some of those industries, parts of healthcare, aged care, for example. We've certainly seen that. The security industry as well. To be very open about it. What will working arrangements look like in a post-COVID world? Is it possible for us all to be continuing to work from home? I would argue the answer to that is no. At least if I think about it in two senses. One is a corporate culture sense. How do you maintain some sort of culture, some sort of team culture, corporate culture in your business when everyone is working from isolated shoeboxes around the country? Call me old-fashioned, but frankly, I don't believe there's any substitute for being in the same place as someone and engaging with people you work with and people you do business with. Working from home will continue to have its place. And certainly those businesses that had previously told their employees, no, you can't work from home, that would never work. Well, those businesses need a better story, because clearly in large numbers of cases, working from home does work, and employees can certainly be, potentially even more productive than they were in the office. On the other hand, there's some industries or in some cities where, frankly, working from home is really miserable and doesn't work. At the risk of stating the obvious, if you're working from home, is a really nice 3-bedroom home in a nice suburb in a major city where you can easily isolate yourself from the rest of the family and from your kids and go about your business, then working from home is a hell of a lot easier than if you're trying to raise a family in a 2-bedroom shoebox in Hong Kong, at the risk of stating the bleeding obvious. So working from home arrangements will vary dramatically, not just across industries, but across countries and cities, etc. I have no idea what travel and tourism looks like in a post-COVID world. In the absence of a vaccine, how do we actually return to something even resembling normal in terms of travel, tourism, hospitality? I don't know what that looks like. Before everyone came on, Damian and I were discussing, the way that technology has really stepped up and played a role in helping society manage this. And certainly there is scope for technology to help be part of a solution. What if, for example, and again, I'm just tossing it out there, we now have a test. We now have a COVID test which can give you a result in 15 minutes. What if you actually could do a test which could give you a result within 1 to 5 minutes? Does that mean that air travel could start to look very much like normal, because you could literally test people and get a result at an airport before you let people get on a plane? So, but all of this is going to take time, and no sort of reasonable recovery in travel and tourism can happen until we get infection rates down to such a low level that they can be easily contained and that you can manage this risk. The other thing I just stress is that a big difference about this recession, and here I'm wearing an investment hat. Going into this, there was a fairly widely held view in the investment landscape that if I looked at the prices being paid for some of the big technology stocks, particularly in the United States, so your Facebooks, your Apples, your Googles, your Microsofts, etc., that the valuations that were being put on these stocks were very much close to perfection. Now, normally when you get a recession and prices of assets fall, those assets that are most overvalued tend to actually fall the furthest. This time round, this crisis has actually benefited those technology companies. So rather than actually damaging those companies, literally these companies have been prime beneficiaries of what has been going on with COVID-19. And my final point about the role, about post-COVID world, what is the role of government? And again, this may be a bit controversial, but hey, let's go with it. I think one of the lessons, I hate learnings, lessons out of COVID is that during a crisis, you really want government to step up and do stuff. And the ability of governments to step up and do stuff basically requires those governments to be well-resourced with highly skilled people who can actually step up and solve problems that the private sector is unable to solve. If you spend years and years starving the public sector of resources, do not be surprised if the public sector finds it hard to step up during a crisis. I think in Australia, we are relatively lucky. I would rather be us than be the United States, at the risk of stating the bleeding obvious. But certainly I think as part of a wider conversation, what do we want governments to do for us? And what do we want governments to be prepared to do for us, especially in a crisis environment, and how are we going to pay for it? And what this means is that we need to change the debate around tax. If you think about the way people talk about tax in Australia for the last 30, 40 years, whenever someone utters the words tax reform, what is the first thing that comes into people's minds? The first thing that comes into people's minds is, great, how much am I going to get back? How much less am I going to pay? Well, I'm sorry, that needs to change because we need to be far more sensible about saying how much money does the government need and how are we going to raise that money in the fairest and the most sensible and efficient way possible, because we need governments to do stuff. That is a major shift, I think, in the debate, which will play out, I think, over some years to come. Now, a word of warning, the rest of the presentation, much of which contains very confusing, colourful charts, because that's what I do. This is what economists do. We put up confusing, colourful charts that hopefully make sense. This chart just shows you just how bad business conditions became in the first half of this year. This is what's called the Purchasing Managers Index. It's a key index of global business conditions. And I've broken it up by the world, the emerging markets and the developed markets. And I've broken it up by industry group, if you like. Below 50 basically means that businesses are saying the economy is shrinking. Above 50, businesses are saying, yeah, we're expanding. Now, the depth of that fall was truly disastrous and vastly exceeds really anything we've ever seen in the history of this survey. Certainly worse than the GFC. The fact that we've now seen a bit of a rebound, that simply tells us that, yeah, we've started to grow again, but we're growing off a very low base. You know, in the first half of this year, economies basically shrank by a considerable amount. Now, and it varied significantly. Some economies that were able to get infections under control very quickly were able to actually get through with not a lot of economic damage. Other economies that weren't able to do that suffered much more severe economic damage. But so you have seen a lot of variation, but you are also seeing variation in the recovery. And I really like, as an economist, I really like this data. As something of a civil libertarian, I hate this data. This is the numbers that Apple, Google also published similar data, but this is some numbers from Apple, where they basically keep a track of how many times people pick up their iPhone and look for directions on a daily basis. The spikes basically means that we don't work 7 days a week. We have days off occasionally. And they started measuring this in the middle of January. So what it shows you is that it's a measure of mobility. Are people moving around? Are they spending? Are they going to work? And it means people asking for directions to either drive somewhere, walk somewhere, or catch a train or bus somewhere. Okay? So as we started this year, we sort of were kind of humming along, and then we saw this dramatic collapse in activity. And that collapse was fairly uniform. Everyone was kind of in a similar boat. But since then, you've seen a very, very uneven recovery where some economies, some markets are doing better than others. Some markets, after an initial spike, have started to taper off again. Other really badly affected places, and I'll nominate Italy here, the Italians seem to have done a really good job of this. of managing this outbreak, and indeed the economy is likely, at least touch wood, you're basically seeing infections staying under control at a time when people are still moving around, and that's a good thing. In Australia, we've seen mobility come off again. That is largely Victoria, but partly New South Wales. And I should note that a lot of this started to happen even before the lockdown was put in place. What's interesting is it's not all about lockdowns. What we also find in a number of places is even before governments take steps to lock people down, there are signs that people tend to vote with their feet. They see the infection rates rising, they see fatality rates rising, and they vote with their feet, i.e. not to move them. That they kind of, to some extent, isolate themselves before the government steps in and does that. So we are seeing this very uneven recovery. Here in Australia, we've seen really the worst labour market numbers we've seen in decades, many decades, but we are seeing some kind of a recovery, but it is very, very gradual. The ABS in Canberra have started publishing weekly payrolls numbers, the number of people on single touch payrolls, basically. And it's given a very good timely read, and they publish them once a fortnight, to be fair, of what's actually happening in the Australian labour market. And they started publishing it in the middle of March. So the chart on the left here just shows you the very, very steep fall in the number of people getting paid, number of people on payrolls. You've seen a recovery since then, but obviously that fall away in Victoria is very, very stark. You've also seen signs where some of these job gains have started to level out a bit in other places. Western Australia, courtesy of ongoing quite strong activity in mining, is continuing to sort of chug along fairly nicely, as is South Australia. The chart on the right just shows you what I think is a really good broad measure of the health of the labour market. It basically takes into account the people participating in the workforce, people actually getting a job, and the ability of people to get a full-time job. Because ideally, if you want the economy to be really productive, you want as many people as possible who are willing and able to work to do so, and where they can and where they're willing to be employed full-time. Because that kind of maximizes, if you think, the productive capacity of our economy, if you like. And what this shows you is that the percentage of the population in full-time employment has actually been in long-run decline over many years. And this is really the rise of part-time work, for example. This is partly the rise of female participation and women choosing to work part-time, but it's also a sign of an increasingly casual and flexible workforce as well. We have seen that collapse again. We've seen the beginnings of a recovery, but it's very, very early days. There is still so much excess capacity and so much surplus labour out there in a macro sense that it's it's going to be a long drawn out process to get our labour market overall to look vaguely back to normal, or even within cooey of what you might call full or natural levels of employment. That's not to say there won't be pockets where you will have skill shortages, where you're going to have pockets where certain skill shortages will play out, and you will see wage pressures potentially there. But in a macro sense, this is going to be a long drawn out recovery for our labour market.
We're seeing some of those in Western Australia now, Brian, where
Absolutely.
there is a little bit of wage pressure on some of the skill sets. But it's how long with that, will that curve flatten there, or how sustainable is that? Because it's driven largely by iron ore and gold. What does that look like in 2 years' time?
I think in the absence of some sort of return to interstate and international migration, it's very, very hard to see that being remedied. And I think that's, as I said, the sooner we can get infections across the board, back under control, open borders, allow free movement across borders, the better for all concerned. The other thing I thought I'd share with you, I mentioned that you get a lot of variation between different economies and regions about, how successful your recovery post-COVID is going to be. And here's just some of the factors that are going to determine what success looks like in an economic and other sense. Your abilities to succeed in recovery post-COVID is going to depend on a range of things. One, how much support is the government and the central bank, but particularly the government, is going to be prepared to step in and help. That's going to be really crucial. what industries make up your economy. If you're an industry which is heavily exposed to international tourism, you are clearly going to be a lot worse off than someone who is not. Infection control success and the risk of resurgence. How quickly can you clamp down on renewed outbreaks? If we can get the whole world to basically look kind of no worse than New South Wales, we're pretty sweet, because it means you can return to something vaguely normal, keep infection rates pretty much under control. When you see a bit of an outbreak, slam down on it hard, but without having to go into sort of renewed lockdown. Trade linkages. If you're doing business with a bunch of economies that are doing well, then you'll probably do well in a relative sense. If you're not, you won't. Labour market flexibility. To the extent that we were able to basically send people home at the drop of a hat, how quickly can you bring them back on stream? How quickly can you bring people back to work? And that very much goes to how flexible your labour market is. And financial stability. During this crisis, here in Australia, for example, we have relied on our banks, also government, but we've also relied on our banks to both support their borrowers, households and businesses, through the worst of this, through things like loan repayment holidays. But we've also asked banks to provide funding to companies so that they could keep paying wages while they waited for the government to fork out JobKeeper. Okay, so rather than the government actually fork out the money straight up, they basically said, no, you pay people, then you come to us for reimbursement. That's fine if you've got cash flow already, if you've got sustained cash flow, and it's fine if you've got cash reserves, but if you don't, you needed to rely on your bank to help you out in the short term. Where that wasn't possible, you fell through the cracks, just quietly. So financial stability is crucial, because if your banks are not in a strong position, they can't help you. And again, Australia did rank fairly highly on that score. Now, this really ugly slide, but please bear with me. A lot of controversy and a lot of discussion about, is there a trade-off between what sort of economic weakness can we tolerate in the interest of keeping the virus under control? Or is there, and some of this kind of gets a bit, really gets quite nasty, I think, this conversation, to be very frank with you. You know, how many people are we prepared to let pass away in order to protect the economy? I'm in the camp that basically says, and again, there's a range of views out there, but I'm in the camp that basically said, look, if you wanted to minimize the economic damage, you basically needed to be Taiwan or Korea, but particularly Taiwan, but also Vietnam. The Taiwanese and the Vietnamese have nailed this, because they basically saw what was happening in China, and they said, you know what, we've seen this movie before. It didn't end well last time. We know how this plays out. So they just took the kind of steps they needed to take fast and early. They weren't in denial. They actually moved very, very quickly. And so consequently, their economies have fared relatively well, and they've had very, very few infections and even fewer fatalities. Okay, but if you didn't do that, if you took your time to respond, or you were just overwhelmed, then either people started to lock themselves down, and then you had to add to that, and you ended up with quite severe economic impacts. Now, what I've done here on this chart, so every dot is a country. I didn't want to label all the countries because the chart would look even uglier if that's possible. But the vertical axis is the total number of cases you've had in a cumulative sense per 100,000 of population. Okay, so cases per capita. And the bottom axis is how far your economy shrank during the first half of 2020. Okay, and the dotted line there is just a simple regression line. It's just a line of best fit, okay, to try and say, well, is there a relationship here? Is there a relationship between, you know, can I basically say that the more cases I'm willing to tolerate, the better my economy will be? Or vice versa, can I say, well, the more cases, the more I can control my cases, I'll make the economy somewhat better, or whatever. What is the relationship? And I draw a few things out of this chart. Firstly, it's complicated. The success or failure has varied dramatically across the world, depending on a whole range of factors, and even a lot of societal factors. So think about, let me give you a few examples. Japan, Japan has actually fared relatively well in this case, partly because, yeah, they responded fairly quickly, but also for those of you who've been to Japan, you'll know that as a society, there is a very high standard of both public and personal hygiene. If people have a cold, they wear a mask under normal circumstances. They don't need to be told. The place is spotless. Everything runs really efficiently. And so that means that it's easier to deal with a crisis like this. You don't get the same risk of spread, perhaps, as if you're in a society where people take wearing a mask as an insult to their personal liberty. No names mentioned. Okay. I also just thought I'd show you here that I've labelled Australia at the bottom. So, yeah, our economy, we've had very, very few cases, but our economy has done probably better than many, but we've still suffered. I should also point out that I've labelled Sweden. Now, Sweden gets held up as the poster child for, see, protect the economy, look after your vulnerable people, protect your economy, and just get the rest of the community to behave sensibly. Now, in theory, that sounded appealing because the Swedes are much more like the Japanese in terms of their ability to follow instructions, be generally clean, than, say, the Americans. Sorry, I didn't want to make the Americans sound unclean, but you know what I mean, right? If people are used to responding appropriately to competent authority and are used to taking sensible steps and are quite happy to abide by sensible measures in response to a health crisis, then maybe you can get away with a relatively light touch approach. But what this chart suggests is that that approach has basically said, well, your economy's done about as badly as anywhere else. It's certainly done about as badly as your near neighbours. So the Danes, the Norwegians and the Finns have basically done about as badly as the Swedes. The Swedes have done about as badly as they have. But the difference is that you've ended up with a lot more dead Swedes. That the fatality rate is actually well above trend. And I've highlighted the very, very top of the slide there, the outliers. So Chile, Brazil, Israel, and the United States, where not only has the economy been very, very hard hit, but you've also had some of the highest infection rates in the planet. So this idea that there's an obvious trade-off, I don't really buy it. There's so many variables here that it's really, really hard to be definitive either way. By the way, if I were to be statistically clever, and just eliminate my outliers, if I was going to be, you know, what economists are accused of doing, and namely cherry picking data, if I blocked out Brazil, Israel, US and Chile, and I just drew a line of best fit through the rest of them, it's a much better, stronger relationship. It very strongly suggests that there's a strong correlation between minimizing the economic damage and minimizing the disease. Okay. But in the interest of full disclosure, I included the outliers. A lot of variation across the world in terms of, you know, which countries have been hit hardest by this, and a lot of variation in short-term infection rates. And what's happening in Europe right now, in particular, is really disheartening. So the chart on the left is just the total number of cases per 100,000 of population for a range of countries, and no surprises who's been worst affected. And by the way, the Chinese numbers at the far left of that chart, I don't believe the numbers, just quietly. Don't want to say any more about that. I just simply don't believe the data. The chart on the right just shows you the short-term trend. And what it shows you is this week versus last week. What's the change? Is the trend rising or is it falling? And what it's showing is that the trend is basically rising again in major European economies. It's still rising in the United States. Whereas Australia, at least over the last few weeks, we've started to get that trend back under control again, which again is really, really pleasing. And to show you how quickly this can change, on that right-hand chart, the country to the far right is Spain. Now, I would guess if I updated this chart today, it's back up again. So you're still seeing a lot of volatility in this data. It's very uncertain, very volatile environment is really what I'm trying to draw out here. I mentioned, you know, who's most exposed from an industry point of view. So this just shows you tourism as a share of GDP. This is numbers from the OECD. So it's basically think of it, any industry that's exposed to visitors, either from somewhere else in the country or somewhere overseas. What percentage of the economy does tourism as a whole represent? So again, no great surprises that countries like Spain and Croatia and Portugal and France are really vulnerable here. because tourism makes up a sizable chunk of their economy. It will surprise you, Australia looks relatively low on this. So in terms of Australia, tourism is about 3% of our GDP. So we're perhaps not as exposed as we may think. But a couple of things, a lot of variation here, but I think, you know, your industry exposure does go a long way to actually explaining, you know, how vulnerable or otherwise you are. If your primary industry, for example, is somewhere like Singapore, where you've got one of the most well-regarded airports in the world, that airport is just handling a fraction of its normal volume. You know, Dubai being another case in point. The other thing I just wanted to share, just on back here in Australia, and pose the question: what sort of economy will we recover to? What I'm about to say is going to stand. This is going to be a really, really tough few years. I make no mistake about this. I'm wondering whether we go back to arguing and worrying about the same things we worried about 9 months ago. 9 months ago, if I was doing this call, I would worry about things like Brexit. I would worry about things like US-China trade tensions. And locally, I would worry about how weak wages growth was in our economy and what that meant for, you know, the strength of household balance sheets and spending. Well, guess what? We're going to be starting to worry about that again. In fact, we already are. US-China trade tensions have not gone away. Brexit has not gone away. It is going to be every bit the disaster that people feared, because the grown-ups are not in charge. And this is really not going to end well, in my humble opinion. It would take a miracle to get some sort of respectable deal that would facilitate trade between the UK and Europe between now and 31 December. I frankly think they're dreaming. Here in Australia, this confusing chart, the blue line here is the rate of growth in private sector wages. Now, those of you who are eagle-eyed will notice that that blue line is upside down. So when that blue line is rising, it means wages are slowing down. So we've already seen a fairly marked slowdown in wages, and that is before the worst of the impact of the labour market starts to hit. The amber line on that chart, which is not upside down, is what the ABS calls the labour force underutilisation rate. It's the percentage of the workforce which is either unemployed or underemployed. That is improved a little bit, but you're still talking about 18% of the labour force that is underemployed or unemployed. And just eyeballing that chart, what does it tell you about the future direction of the blue line? It basically tells you that wages are going to slow down further from here. The government and the Reserve Bank are basically saying they think wages are going to grow at, say, 1 to 1.5% for the next couple of years. I think that I would be polite and say that I think that's aspirational. I think it could easily be weaker than that. So we end up with this fairly anemic, weak growth in household spending and income, I should say, as the recovery progresses. The other thing is, I do fear that a number of businesses simply will not survive this. And this is kind of normal, even though there are certainly very unique aspects about this recession, particularly one that was kind of engineered. The one thing it does have in common with its predecessors is that this recession, not all businesses will survive, despite the best efforts of either governments or their banks or their managers. That it's fairly clear from some of the stats that if I look at the financial health of a range of businesses in Australia, we went into this not exactly in peak financial condition. And this recession is really, the chickens are coming home to roost. There was a great survey done by the ABS a few months back where they asked thousands of businesses in a range of industries, a range of questions about their financial health. And one of the questions was, how much cash have you got on hand? What does your cash reserves look like? And this shows you across a range of industries what percentage of businesses basically said, I've got less than 6 months cash. 60% of retailers said, I have less than 6 months cash on hand. Overall, it's nearly 50%. Some of these businesses, perhaps many, will not survive. When you talk to bankruptcy practitioners, insolvency practitioners in law and accounting, they will tell you that they are literally expecting an avalanche of business over the next 12 months. As a number of these businesses, they simply cannot be kept on life support forever, either by governments or by their banks. That a number of these businesses simply will not survive. The other thing I wanted to talk about was the fact that I think the consumer, this is the kind of crisis which changes people's behaviour for decades. Just as some of our great-grandparents and grandparents came out of the Great Depression forever changed in a financial sense. Think about some of your elderly relatives who spent most of their lives detesting banks with a passion. Why did they do that? Because they saw what bank failures and bank foreclosures did to their families and their businesses during the Great Depression. And they've went through the rest of their lives never trusting banks. And I'm not saying this is going to happen now. I'm just simply saying that that episode changed their views of the world and changed their behaviour. I think you'll see the same thing here. This is being a big enough crisis that it will change the way people behave for many, many years to come, most notably in a financial sense. I think you'll see a far more cautious consumer over the next decade than you've seen in the last decade. Perhaps we're already seeing signs of that. The chart here is the rate of growth in private sector credit. Now, the grey line at the bottom, which was shrinking and has accelerated downwards, that is what's called other personal credit. So it's credit cards, car loans, personal loans. So non-mortgage credit, basically. So we're still taking on loans to buy houses, and that's great. Not so much taking on loans to buy investment property, but certainly to buy houses to live in. You're still seeing some of that. And you've actually seen, surprisingly, a pickup in the share of loans going to first home buyers, which is pleasing. But in terms of other personal credit, people are cleaning up their balance sheets to some extent. People are actually getting out of debt that basically is non-productive. That's no bad thing longer term, but it does, I think, highlight the consumers are becoming a bit more conservative. One of the puzzling things is house prices. What happens to house prices from here? So this just shows you the level of house prices in our major capitals. Everyone talks about Sydney, Melbourne as if they're the only cities on the planet, and I get that. But you know what? There are other cities in Australia. Look at what's happened to property prices outside of Sydney, Melbourne. You know, Perth property has been in decline now for 7 years. Brisbane and Adelaide property have really done not very much at all anyway. But so much of the discussion is, well, will you see a major collapse in property prices? My answer to that is, firstly, well, it depends, because that's what economists say, it depends. Depends on what happens to the labour market. If our labour market continues to recover, and if unemployment does come down in the new year, and therefore we can minimise the number of people who are forced to sell their home, then we may get away without a massive economy-wide 20-30% collapse in property prices. Okay. Despite that, I'd note that, are you going to get much of a collapse in property markets which didn't have much of a boom to begin with? Put it out there. The other thing I'd say is you'll see a lot of variation, not just between different capital cities, but between different other subgroups of the property market. I don't think it's possible to generalise about the Australian property market. I think it's far too variable. Let me give you some extreme examples. You know, if your property price, if your investment property is in an area which is highly dependent on tourism or highly dependent on overseas students paying their rent and being on site, or highly dependent on immigration flows, then frankly, you're in trouble. That those areas of the property market, I think, are going to really struggle for at least the next several years. There'll be a range of overseas students that frankly will not come back. So a bunch of the investment properties that have been built to meet that demand, I do worry about that. A bunch of investment properties that have been built to try and attract Chinese buyers, I worry about them too. But other areas which you aren't exposed to any of that, where frankly the people who live there have kept their jobs and have kept their salaries, you may not see much of a change at all in property prices. So you'll get a lot of variation, is what I'm saying. You can't give a blanket forecast for what's going to happen in Australian property. I've already touched on a lot of this in terms of the longer term impacts of COVID. I'll close on this note. You know, what does the future of work look like? What is work from home? Is the office dead? I think the answer is no. Configurations change, and while there may be fewer people working in offices, every person will need more space, especially in absence of a vaccine. If the flexi desk dies a painful death, hallelujah. Okay, because frankly, I think that's an abomination. It really, if you want to actually make people feel less connected to their workplace, make them fight for a desk every day. Sorry, I'm sounding old-fashioned, I know. And I just put it out there, the role of government. What do we want governments to do for us, especially in a crisis? And I think this is really, we had a warning sign, by the way. Remember a few years ago when our government couldn't even run an online census because their IT was stuffed? That was a warning sign which told you, you know what, I think we've starved the public sector of some fairly basic resources, even in something as basic as IT. So I just put it out there. Look, again, thanks to the Oncore team for the invitation to come and speak. I think we've got about 15 minutes left, which I'm more than happy to take questions on any of this or anything else you care to ask. But thanks,
Yeah,
Damian, and thanks to the rest of the team.
Thank you, Brian, from Sunsuper. A couple of questions
all the time, mate, don't worry.
A couple of questions starting to come through. One was in relation to Afterpay growing rapidly. People taking on short-term debts and paying later. Do you think it's going to continue or decline? What kind of effect do you think that that will have?
It's a really good question. I don't have a strong view, but I will say this. Look, the shares have done remarkably well, and certainly, you know, again, Afterpay is one of these companies that have been a beneficiary of COVID with online shopping and stuff like that. My question would be, look, is that business model sustainable, viable? Yes, I think it is. Absolutely. Is there the potential for consumers to get into trouble and get in over their necks and get into too much debt? I think the way, and again, I think the way Afterpay structures their arrangements, that there's not a lot of chance of that. That if someone gets into trouble, they pretty much get cut off from Afterpay. But I don't get the sense that you're not exposing households to the kind of financial risk potential that you would if you get into trouble on your car loan or personal loan or credit card or mortgage. So I suspect the business model is sustainable, absolutely. As an investor, I question how much money I want to pay for these shares, because I think that applies to all these technology companies, fintech and other technology companies. They were and have been priced for perfection in many cases. So I worry about that, but I don't worry so much about the business model. That's sort of my view at this point.
The business model's been around for years.
Exactly.
We're a similar age. It's lay-by, I think, was something that used to be called by some of the department stores. So.
Absolutely. It's not reinventing the wheel. No, that's right.
Another question here, Brian, is in relation to the government the regulations imposed by government on banks post-GFC. Do you believe that banks will retain much of the regulation to keep their bad debt in balance?
I worry about, again, this is controversial, so it's just a personal view. I do worry about the recent measures the government have announced to basically try and free up, make it easier to borrow money. In particular, try and relax, try and encourage banks to be a bit less heavy-handed with the paperwork. And I worry about that. I think if we let the pendulum swing back towards the kind of lending practices and really light touch credit assessment that we saw in some cases, pre-Royal Commission days, etc., I worry about that. Could we be on a call like this in 10 years' time, talking about another Royal Commission into bank lending practices? We could do, absolutely. But I think the bigger problem right now is not so much, if you're a credit-worthy borrower, can you get a loan? Yes, you can. Will you have to jump through more hoops than you otherwise would? Well, until these regulations go through, yeah, you probably will. But I also think the bigger issue is we're in the midst of the biggest recession in decades. People's appetite to borrow money is going to be depressed. Banks' willingness to take extra credit risk is going to be depressed. This is what happens during a recession. You can make the paperwork as easy as you like, and that ain't going to change the fundamental environment where we're in. And that, to me, is the bigger issue. So I'm a little concerned about relaxing regulations at this point and easing restrictions on bank lending, but it doesn't keep me awake at night. It doesn't give me, I just don't think you'll see I don't think it's a panacea for the economy, and I don't think it makes a hell of a lot of difference to people's appetite to borrow. I also think you're also seeing it a little bit in some of the data on bad and doubtful debts, which have started to creep up. They're still low, but Australian bad and doubtful debts and banks and provisions, delinquent loans have been so low for so many years that the fact that they've risen, it looks really stark on a chart, but it's actually still pretty low. So much will depend on how the economy plays out over the next 6 to 9 months, and how many people, after the government support starts to wane and after the labour market heals or fails to heal, how many people actually get into trouble and get forced into foreclosure effectively. That's going to be the bigger issue for me.
Question here in relation to government stimulus investment in technology, NBN. Do you expect to see more of a switch away from physical infrastructure?
Yes and no, although I am a fan of the idea of governments doing more to facilitate the transition to sort of green tech. And again, I know this is a controversial view, and there'll be a range of views even on this call. But if I look at the economics of this, and I look at what investors are telling us all around the world, we talk to major infrastructure and private equity and technology investors and energy investors all over the world, and they're all saying the same thing. The trend is very, very clear. It is towards longer-term renewables and improvements in battery storage capability, and it's away from things like thermal coal and eventually too away from things like gas. And so the sooner governments can actually help to facilitate that through some physical infrastructure spending, I wouldn't have a problem with that at all. Yes, there is certainly scope for governments to do more with the NBN. The irony of the government now going with fibre to the premises is not lost on anybody. But I do think that in terms of physical infrastructure, yeah, there is a lot more to do. Yes, I don't doubt that at all.
Interesting question, but I know you probably can't answer it. What would be the best investments be currently?
Oh, no, I can't answer it.
I can't answer it.
Well, yeah. I can't give a specific, I won't give specific advice, but let me answer more generally about where we're seeing opportunities, okay? And how we're seeing the investment landscape. We have a range of asset classes we can allocate to, okay? Shares and bonds and property and infrastructure, domestic and global, etc. The reality is that share markets still look to be very attractive when you compare them to the returns on things like cash, bonds, and term deposits. Now, that is kind of like saying I'm the best looking guy in a room full of butt ugly people. It's not a ringing endorsement, okay? The reason shares are attractive is because everything else is really ugly. Look at the returns you're getting on cash, term deposits, and government bonds. If I today buy a German government bond, I'm lending money to Angela Merkel and her successor for the next 10 years. I pay them 0.3%, 30 basis points per annum for 10 years for the privilege of having the German government look after my money. Yields are negative. I'm literally paying to lose money. That is insanity. But that's if that's the alternative, would I rather invest in the share market for the longer term? Resoundingly, yes. But that doesn't mean that share prices are an absolute bargain or that share markets aren't going to go through very difficult, volatile periods. They inevitably will. But to us, shares look very attractive compared to cash, bonds, and term deposits. What still looks attractive to us, we're still finding opportunities in things like infrastructure globally and here in Australia, but particularly globally. Private equity opportunities continue to come across the desk, as do property opportunities. We're still getting good flow of deals that can come through the door where you do the math and they're capable of delivering the kind of returns our members need. At the end of the day, I and the team I work with here, we tell our members that after inflation, after fees and after tax, we want to deliver for them 3.5% on top of all of that over the next decade, CPI plus 3.5 net. Where am I going to get that from? When the cash rate is 0.25, when the government bond yield is 0.8, well, they ain't going to get me CPI plus 3.5. Shares may well do, but things like infrastructure and property and private equity, yeah, probably will. So I need to make sure that we continue to invest in these sort of, I'll call them non-traditional asset classes where we think we're likely to get perhaps more reliable long-term returns. That's kind of where we're at right now. But I make no mistake, this is a really challenging investment environment. I worry about people who are in retirement trying to invest in such a way that they protect capital and get a decent income. Getting a decent income out of bonds and cash and term deposits is extraordinarily difficult. And I can do something to add to the yield. I can basically invest in corporate bonds as opposed to government bonds, but I am taking more risk. Companies go bust, governments generally don't. So there's a limit to what I can do to boost returns in this environment. It's a real challenge. So that's kind of how we're seeing things at the moment.
We've got a question here on property as an asset class, and I know you touched on residential, so I'm assuming it's in relation to commercial property. Yep. The article on Monday evening on Four Corners, there's a statement made that 15 to 40% rent reductions across the board, and a drop in that asset class. What are your thoughts on that?
Oh, look, I don't doubt that in some markets you will see that, but I don't think it's an across the board thing. The second thing I'd say is that my point earlier about corporate culture and team dynamics and productivity that flows from that, work from home doesn't suit everybody. It doesn't suit every industry. In fact, plenty of industries it doesn't suit. It doesn't suit corporate culture. So you'll need some kind of physical presence for people to be drawn to. And you can argue about the configuration of that and what price you need to be prepared to pay for that. So I think in an overall sense, in a net sense, you'll get a shift down in demand for property, but you don't get a shift down to zero, but you do get a shift down. You will get a hit to rents, I think, undoubted. And I think a lot of the valuations on these, a lot of the valuations that have been put on these properties, certainly on, especially the ones that are held by super funds such as ourselves, they've already been marked down to reflect what is expected to be a very challenging rental environment. We don't tend to hold as much in big ivory towers as some of our peers do, but we do hold some, so we're not immune to it. But I do think you'll see rent reductions, absolutely. You'll see a whole bunch of incentives from landlords to keep quality tenants in place, I suspect. But longer term, will you see a drawn out recovery in that? Yeah, I think you will. So as I said, the death of the office has been grossly exaggerated.
Yep. Well, I've got two questions in relation to Victoria here, and I think one's a policy decision based on the Victorian government procurement gaps. How will businesses buy? Will they be weighted heavily towards large vendors from a risk perspective, or and then, ironically, what does that mean for smaller professional services? A good question.
It's a good question, which I don't have a great answer for because it's just so micro. And it's a really complicated question. I think the best thing I could say is, are you likely to see? I think, the Victorian infection rates have come way down, which means can we be confident that you will see an opening up? It's simply a matter of time and speed of that opening up. You will absolutely see that. But in terms of what that means for people's purchasing behaviour and whether you see, supply constraints in the short term acting as an impediment, I think you will see parts of that. And maybe there's a role for government to step in and help with that, although it's not automatically obvious to me how they could. So look, I don't have a good answer beyond that, I'm afraid, because it is kind of micro and it's going to vary a lot. Industry to industry and place to place.
Yeah.
So,
and as a Victorian, another question here: how bad do you see the long-term impact on Victoria relative to other Australian states, especially if the government continues the lockdown measures past Christmas? I haven't seen the stats today, but it's basically, what does Victoria look like over the next 3 to 12 months is probably the question.
Yeah, look, to me, I remain a longer term optimist. I think you will see an opening up. I think the fact that they have gone hard, which over the recent months, means you're perhaps more likely to see a bit more of a durable containment down the track. And so I don't see renewed lockdowns because I do think that they've been so aggressive this time around, and you can argue about whether they should have eased off sooner or not gone as hard. Personally, I think the curfew was overreach, massive overreach, was unnecessary in my view, just quietly. But I think that if I was to look at the way Victoria looks in recovery, think New South Wales -2 months, but the end result's the same. That I think Victoria still, the potential, the underlying strength of the economy, the underlying strength of hospitality, of retail, of education, of parts of manufacturing that underpin the Victorian economy, none of that's disappeared. Those underlying strengths haven't gone away. So I think the recovery happens. It proves to be durable. And so in terms of timing, it's simply just, it means that Victoria is, T-2 months, if you like, compared to, say, New South Wales. I think that's, to me, that's the most, so I'm an optimist on that.
It was pleasing. I saw that you mentioned China, but an exhibition, I think it was the International Car Show or the China Car Show, was going ahead, and there was thousands of people there. Is that something that we can aspire to here in Victoria in 12 months, 3 months, or 6 months?
Yeah, I think 2 or 3 months, no. 6 to 12 months, yes. I, as I said, remain pretty optimistic about that. Will there be some basic precautions that need to be put in place? Yeah, there will be, perhaps for some time, and indeed perhaps everywhere. But can you go back to actually running fairly sizable events at things like places like Jeff Shed and here at the ICC in Sydney? I think a resounding yes. It is simply a matter of time. As I said, I don't think it's 2 or 3 months, but 6 to 12, I think yes.
Is a good question. Do you think we'll see negative interest rates in Australia?
It's an excellent question. I'll go by the comments. No central banker really rules out anything, right? They always give themselves optionality. But Governor Lowe and his team have come as close as a central banker gets to basically saying, that they're not convinced it actually works. That all you end up doing is you end up providing some distortions in the system which aren't really helpful. If you're not going to borrow money and spend it when the cash rate is 0.25%, -10 or -20 basis points may not convince you. The other thing is that, you also, if you take interest rates too far negative, you're effectively imposing such a cost on the banking system. You're effectively and such a penalty on depositors that people start to withdraw money from the banking system, and therefore you restrict the ability of banks to actually provide credit to the economy. So you end up doing more harm than good. So I think right now, there's really not a hell of a lot more the central bank can do. It is up to governments to step up and to the plate. So far, governments have mostly done that, although the US dropped by letting some of their measures expire 31 July. That was a major error. The fact that we're tapering off JobSeeker and JobKeeper is more sensible than turning it off. But I think there's going to need to be further changes there to push that further out as well. And more on the infrastructure and support side there, I think. The central bank really can't do a hell of a lot more. So short answer to negative interest rates is no from me.
Wonderful. Wonderful. Okay, I think that's our hour is up, Brian. I know you love statistics. I've just done the calculations. You've managed to retain 92% of the participants, which is extraordinary in this day and age with so many webinars going on. So really would like to...
webinar fatigue, I swear.
Yes, but thank you for your time today. It's been very insightful. I'm sure that many people would love to have you over for dinner party bookings and just to listen to you with those insights. So thank you to everybody that came on. We will, somebody asked the question about whether we will send a copy of the presentation. We will. So in due course, and I'm sure that Noam, our marketing manager, is also collating some of the answers or some of the questions that we haven't been able to answer, or Brian in particular hasn't been able to answer as well. So thank you to everybody for their participation, and well done, Brian. We really appreciate your time.
Thank you, Damian. Thank you, everybody, for your time today, and to friends and colleagues in Victoria, our thoughts are with you. Hopefully there is light at the end of the tunnel now, so we can all return to something vaguely normal. But thank you, everybody, for your time. It's much appreciated.
Thank you. Appreciate it, Brian.